Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. Well, this segment is brought to you by my company, Bull Realty, for client-focused asset and occupancy solutions. Visit bullrealty.com or give me a call. Well, today we're talking about 2019 now. What has changed? What should we expect moving forward for property performance, for the economy, for cap rates, for interest rates? A lot of volatility, it seems like, out there. We've had such smooth sailing. I want to welcome back one of my favorite guests of all time we've had on the show before. You may know him, Ryan Severino. And he's joining us on the phone today. Now, he is Chief Economist with JLL. Thanks for joining us, Ryan.
Thanks for having me, Michael. Happy New Year.
Well, thank you. And Ryan, you really watch the market very closely, and you have for a long time. And I'm sure you've kind of had an outlook for 2019 for a while that's kind of been, I guess, adjusted somewhat, but it seems like there's been some volatility recently. What is going on now? Has your outlook for 2019 adjusted any in the last month or so?
Not significantly. I think the point I often reinforce when talking about the last month or so is that it's really critical to remember there is a difference between what's going on in the real economy and what's going on in the markets. And certainly the markets are, to an extent, a reflection of what goes on in the economy, but there are a whole bunch of other things that get baked into market psychology and market behavior that have nothing to do with what's really going on fundamentally in the economy. And that distinction becomes important because when you get caught up in an environment like this where the stock market is volatile and yields are jumping around in the bond market, it's easy to distract yourself from the underlying trends. And I look at the underlying trends and I still see pretty good strength in the economy, maybe not the kind of strength that we saw the middle of last year when the economy was growing at a 3.5% to 4% pace, but I don't see the kind of slowdown ahead that I think the markets are intimating right now. So I think it's an important distinction for everyone to remember that the markets can certainly have an impact on consumer behavior and they can certainly have an impact on corporate behavior, but often the markets and the economy are different things, and I think that's really the case with what's been going on over the last month, 2 months or so.
Right. What about the length of this cycle, Brian? Has the last couple months adjusted anything related to your timing, to how long these kind of good times, if you will last?
I still think we are in for some pretty good times over the next at least 12 to 18 months. Again, hearkening back to what's going on with economic fundamentals, I think it's important for people to remember that despite the fact that we are more than 9.5 years into an expansion at this point, the economy is still growing at a pace that's above long-term potential. I'm still tweaking with the models, but I estimate that we'll see growth in the U.S. somewhere around mid-2s, 2.5% or so this year, which is in excess of long-run potential growth. If you look at the labor market, we are still dealing with an unemployment rate that's hovering near half-century low levels. We're starting to see wage growth accelerating. There are still more than 7 million open but unfilled jobs in the U.S., and just about every survey that you can reference points to the fact that there continues to be a significant labor shortage in the U.S. Consumers are still feeling pretty confident. Businesses are still feeling pretty buoyant about where we are. So as we head into 2019, I think the fundamentals in the economy look pretty good, and I don't see a significant risk of a slowdown in 2019. If anything, I think the markets are probably a little bit too pessimistic on that front. I think they're behaving in a manner that's more reflective of what I think would be a stronger slowdown than what I think we're likely to see this year. I think a slowing in the economy in 2019 relative to 2018 is almost certainly in the cards, but I think the markets have probably been a little too pessimistic in how they've been viewing the outlook recently.
Okay. So, Ryan, what does that mean for interest rate forecast for next year? Has that adjusted for you slightly, or what do you think?
That, I think, has been an adjustment. And that's not just simply due to volatility upset in the market. I think if we actually look at financial conditions broadly, not simply just where interest rates are, but in general, broader conditions, willingness to lend, et cetera, there has been a tightening in financial conditions over the last couple of months that probably occurred, I think, to a greater extent than most were anticipating. And as a consequence of that, I think a few things have happened. Number one, you've already seen the Fed and their last meeting in December back off slightly their forecast for interest rate increases in 2019 relative to what they were saying just a few months prior. Secondly, I think if you look across most professional prognosticators, including myself, we've probably also been forced to slightly downward adjust our outlook simply because the Fed has backed off a little bit. At the beginning of last year, or toward the middle of last year, I probably would have thought more in the range of 2 to 3 rate hikes this year. Now, because of financial conditions, I think that's been revised downward, probably more in the 1 to 2 camp. And I think we'll have to see exactly how the year starts to unfold before we have a little more clarity on that. But in my mind, that's not simply a function of the fact that markets had a little bit of a hissy fit over the last couple of months. I think it is to a large extent owed to the fact that financial conditions have tightened faster than the Fed probably thought that they would, and that's causing them to revise their outlook a little bit. So I still think the economy is strong enough and the labor market is strong enough to argue for the Fed to continue to tighten, but I think because of the overall broad financial conditions, at least taking more of a cautionary approach feels appropriate to me at this point.
Okay, and I like that, Ryan. As an economist, when you're doing a graph for market volatility, is a hissy fit one of the labels?
Yeah, it's a technical economics term that we throw around from time to time.
I like that. So what does all this mean for cap rates, do you think, moving forward? It seems like commercial real estate might be considered kind of the safe part of your portfolio these days. Does that mean, what do you think for cap rates then?
I still see stability in cap rates. I think there continues to be, and I know you and I have talked about this before in the past, but there continues to be this bit of a misperception in the market that when interest rates go up, it explicitly means that cap rates are going up. And I think participants in the market sometimes forget that market fundamentals still matter, and to a large extent they matter more than what's going on with interest rates, because investors will pay more for properties that are performing well than they will for properties that are flat to having declining performance. And where we are in the cycle right now, when you look at fundamentals, they're holding up pretty well, maybe not as strongly as they were 3-4 years ago, but across property types, we're still seeing relatively low vacancy rates, even if they're drifting marginally higher. We're still seeing positive rent growth, even if it's not as strong as it once was just a few years ago. And I think as long as we continue to see relative health in fundamentals, we should continue to see relatively stable cap rates. I don't think we're likely to see the kind of compression that we've seen throughout most of the cycle, and I think the data already is indicating that. In most cases, we're seeing cap rates, at least if not stalling out, appearing to hit a little bit of a floor, and in some parts of the country maybe ticking up a little bit. So I don't expect to see a massive expansion in cap rates this year. I think there's a bit of a tug of war going on between rising interest rates and what's going on with fundamentals. But as long as fundamentals remain relatively healthy, then I wouldn't expect to see a lot of upward pressure on cap rates in 2019.
Okay. Well, Ryan, what should we watch out for? What concerns you when you look at the future of the economy and commercial real estate? What might be a headwind?
There are a few things that I think about when I'm trying to gaze into the crystal ball. The first, which is sort of by definition unpredictable, is what I will broadly call political risk. And I don't mean that in any sort of politically incendiary way, except to say that when you have decisions that are being made for political expediency that don't take into account economic considerations, there are two things that are concerning. Number one, that it's highly unpredictable. It can't really be modeled. It's often idiosyncratic, especially with the tenor of politics and governance these days. So it makes forecasting some of these things virtually impossible. The second thing is it often produces counterproductive results, even if they are, as I mentioned, politically expedient. So that is something that we have to keep an eye on. Policy in general tends to cause problems if implemented in the wrong way at the wrong time. And it seems like as we head into 2019, we could be dealing with a number of those things this year. So keep an eye on the political situation. It adds an element of unpredictability above and beyond the general level of unpredictability that we often have to contend with in the economy. The second thing I would say is keep a close eye on what ultimately happens with interest rates. There's a lot has been made over the flattening of the yield curve, and then at least at the short end, the inversion of the yield curve. But the yield curve continues to be probably the best predictor of recessions that we have. And I'm not ready to throw out the yield curve. I know some people have been heavily discounting it recently, but as I'm fond of saying, the two most dangerous thoughts in economics are this time is different and that will never happen again. So when I hear people say this time is different regarding the yield curve, it makes my spider sense tingle a little bit. So keep an eye on the yield curve. The yield curve really needs to invert before we start to get concerned about the medium to long-term outlook. And I don't think we're quite there yet. We've seen some compression in the yield curve, but we haven't quite seen a full inversion. And the last thing that I would say is really keep an eye on the labor market. The labor market tends to show signs of disruption before you see them in the overall GDP numbers. So pay close attention to not just the month-to-month jobs figures, but also what's going on with unemployment claims. If there's going to be any sort of disruption in the labor market, we would probably likely see it in the week-to-week unemployment claims, which have also been hovering near half-century low levels, before we would see it show up in the actual labor rolls. So just keep an eye on that. And then the last thing I would say, sort of generally, it's important to remember, it's not so much that levels matter when we're thinking about where the economy is going, it's the changes that we see. So pay close attention to the changes that you're seeing in the economy. If things are still improving, but they're not improving at the rate that they once were, that's something to keep an eye on, because usually we see a slowdown in a lot of these variables before we actually start to see any sort of deterioration or contraction in them.
Okay. Well, Ryan, as a final word, what could be the good news? I mean, we have, as you said, we have a lot of great news. A lot of economic factors are very positive. What could be even better news for commercial real estate moving forward?
I think commercial real estate finds itself in an advantageous position right now for a couple of reasons. Number one, I'm going to generalize a little bit, but what we tend to see is when there are disruptions in other asset classes, particularly the publicly traded asset classes, it tends to be to the benefit of commercial real estate. It tends to be viewed in a more favorable light, particularly on the part of major institutional investors or any investors that really will fluctuate or alternate between asset classes or alternate their asset allocations. So any disruption that you see in publicly traded assets like stocks and bonds can be to the benefit of commercial real estate. So I think that's a first important point as we think about 2019. The second point that I would make is even if we are in a bit of a slowdown, which I think is fair to concede, even if the markets have probably overshot a little bit, commercial real estate in 2019 finds itself in a pretty favorable position relative to where we were 10 years ago. And by that I mean, if you look at the fundamentals, they're holding up pretty well, even after 9.5 years of an expansion. But we're not in the excess leverage position that we were heading into the last downturn. And I think we should all take a victory lap, pat ourselves on the back for that, whether we're on the investing side or the lending side, because that kind of discipline will help the sector hold up pretty well, even when the next downturn inevitably comes. Because I think it's economics is a cyclical phenomenon. It's really a question of when, not if. But that said, I think the sector will hold up reasonably well, even if it's not immune to a downturn, because we haven't gotten into an excess leverage situation like we did in the last cycle. So I think there are good things to look forward to for commercial real estate in 2019.
So when it comes to the level of debt on commercial real estate, it is different this time.
It's definitely different this time. I think people got way over their skis during the last cycle, and commercial real estate certainly wasn't alone in that respect. But I think there's been a modicum of discipline that we've seen this cycle that puts us in a far better position, even if we do head into a downturn, than what we saw the last time. The last time the debt situation was clearly excessive, and in certain pockets of the market, it really resulted in some pretty painful results. I don't see anything nearly that dire, even if we are heading into a slowdown over the next couple of years.
Yeah, it seems to me that commercial real estate may be a safe place to put your money right now. Ryan Severino, thank you for sharing your thoughts with us. As usual, great insight. Thank you.
You're welcome, Michael. Anytime. Happy New Year.
You too. All right, well, stay with us. We'll have more on 2019 now. What should we expect at this point moving forward? I'm Michael Bull. This is America's Commercial Real Estate Show. Stay with us.